All right. Welcome, everyone. Thanks for joining us today. My name's Ari Crandall, and Josh Koehnen's with me. We are the managing partners here at Premier Wealth Advisors. Joe LeBlanc is not joining us today because he is knee-deep in taxes or neck-deep in taxes, depending on your perspective. So it is that time of year. We're going to be talking about debt management primarily today, but before we get into that, just wanted to go over a few housekeeping items. There's an attendee chat function on the left side of your screen. If you want to ask us questions along the way, please use that to do so. I'll be keeping an eye on that while we're going through everything. Quick background on our firm. We are a wealth management and income tax firm. So we do financial planning, portfolio management, and tax work. Most everyone that's on here either uses us for one or all of those things, but for those that don't, that's what we do. So with that being said, we'll get into today's agenda. So we're going to be talking about, what we call good debt, necessary debt, and bad debt. But primarily the conversation is going to be around mortgages, student loans, and then consumer debt. So car loans, credit card debt, et cetera. We probably could have an hour-long webinar on each of these topics individually. So this is not meant to be a particularly deep dive in any category, but just kind of an overview and thoughts and considerations as we go over these different topics. Josh, anything I missed? Because if not, we should probably get going on mortgages.
Yeah, it's a great start, Ari, and hello, everyone. And I think to Ari's point, this is going to be high level. We are going to cover this in about 30 to 40 minutes with some questions. So make it interactive if you'd like, in terms of, use that chat function and really ask us the questions that are on your mind in regards to this particular topic. What prompted this for us, Ari, was, with low interest rates, we've been getting tons of questions about refinancing. Questions from, the housing market's been super hot. So we've been getting questions from people about, buying their first home. And then, with all the talk around student loans and potential forgiveness and so forth, we thought, let's just put this all together into one big presentation and chat a little bit online with our people and see if we can maybe deliver some information. So with that being said, we will kick it off with the mortgage discussion. And I'm going to kind of summarize what we're going to cover here. We'll talk a little bit about, some rules of thumb around first-time home buyers, especially in a market like this where things are getting really expensive. We'll talk about, what percentage of your expenses should be going towards mortgage debt and all debts for that matter. The refinancing question, Ari, as I've mentioned, that's something that comes up, more often this past year than I've probably seen in my career. And I think you could probably agree with that. And then home equity lines of credit, when those are appropriate, what they're for, how they work. And then since you've got that tax expertise, we want to find out how the deductibility of mortgage interest works in today's current laws. So let's kick it off with the first-time home buyer discussion. And when you think about being a first-time home buyer, a lot of times, especially in a market like San Diego right now, where things are just out of control, you're competing with offers, and you're trying to be as competitive as possible. And you may not have a huge down payment to be able to put on as a first-time home buyer. And we get asked this a lot. Well, how much of my income should go towards, this particular type of purchase? And then also, what kind of loan makes sense for me? And one of the things we get, for first-time home buyers a lot, Ari, is this idea of PMI. So maybe you can kind of explain what PMI is and how you potentially can avoid PMI.
So PMI, became a bigger and bigger topic after the housing crisis. And when everyone, there was a time when you couldn't give away your home for what you owed on it, right? And so the PMI is an additional insurance that you pay for the lender, right, if you don't have enough debt to equity in the home when you purchase it. So typically, if you have less than a 20% down payment, you're going to be paying some, mortgage insurance, so to speak. And that is what the PMI is. Now, PMI can go away over time. A lot of the refinancing activity that occurred this last year, I just got a note. Can you guys hear me okay? I just got a note that someone couldn't hear me. So, all right.
I can hear you. Let's see. Hopefully somebody else chats to say that they can hear us. One of our team members is on this, so hopefully they'll tell us they can hear us okay.
All right. I got 5 people that said they can hear me fine. All right.
Okay.
So I got 12 people. Okay. Sorry. So anyways, so PMI is, typically when there's less than 20% down. And as your equity grows in a house, that PMI could go away if the debt to equity ratio exceeds that 20%, buffer. So we've had a lot of clients, when they refinance, we'll see that PMI drop off on their mortgage interest statement.
Yeah, other things that you'll see that happen is, the primary mortgage carrier wants to see that 20%. And so sometimes you'll see a situation where you can put 10% down and you get an 80% first and then another 10% on a second or a line of credit that gets you to, the 90%, and then you only maybe have to put 10% down. So that's another way you potentially could avoid the mortgage insurance. But for the most part, if you're going to have less than 20% down, you're going to face the mortgage insurance. You have to factor that into your cash flow and your total amount of payment. And then to Ari's point, hopefully you get to a point where the equity increases over time and you're able to refinance out of the mortgage insurance. The other question we get a lot is, between the different mortgage, varieties that are out there, you got a 30-year fixed loan, you got a 15-year fixed loan, you've got 20s and 25s now, and then you've got these adjustable rate mortgage loans, or ARMs, that were really popular in the last big housing boom. And the question is, what's most appropriate for me? And a lot of times the 30-year fixed rate is going to be the most common mortgage that you see, and it's basically amortizing that loan over a 30-year period of time. You compare that, Ari, to a 15-year loan, then what happens is you're paying it off in a much shorter period of time, which means your payment's going to be higher. And
Right.
so, and what we see is that you'll have a harder time qualifying for that loan, in the sense that your debt to income ratio may not qualify because your payment's too high. And so for the first time home buyer, we're most likely seeing the 30-year be the most appropriate loan. And then we get often, the question about these ARM loans or adjustable rates, and those might be something in the terms of maybe a 5-1 ARM or a 7-1 ARM or a 10-1 ARM. And what that means is that it fixes your rate for a 5, 7, or 10-year period of time. And then after that point, it becomes an adjustable rate. And so the risk to that is, especially in an environment today where you're in a really, really low interest rate environment, if your fear is that interest rates are going to go up in the future and you buy into one of these, let's say 5-1 ARM loans, in order to get a little bit of rate savings today, and then all of a sudden it adjusts in 5 years upwards, you have to be prepared to make that higher payment. And a lot of times there's some provisions in there where it can be capped at certain, or it can only rise a certain percentage each year. But the ARMs I would be very careful with in this environment, primarily because the expectation is that potentially rates can only go up from here. And so you want to make sure that you can afford to make a payment if that loan adjusts down the road.
Right. So there's that factor. And really, this is where you need to make sure that when you're going down this path of getting a new loan, or going and buying a home, that you seek some guidance if you're not sure on what type of loan structure to have. It's really a function of cash flow and timing and comfort, right? So, for example, going back to the 30-year and 15-year conversation, a 15-year loan, sure, you'll pay it off sooner and you'll be out of that, not have no mortgage in 15 years, but you're going to have a higher monthly obligation, right? And you may get a little bit of a lower rate. Usually the shorter term loans have lower interest rates. You could pay a 30-year loan. You could pay it early and pay it down under a 15-year schedule and have the flexibility with your cash flow. And the ARM loans, like I said, they serve different purposes for different folks. Some folks just, they want to get into a place. It's a short-term deal. They know they're going to be moving in 5 years and they just want to, optimize their cash flow. That might be something that works for them. And they're just hoping that the price appreciation offsets the lack of principal pay down. So it just kind of, there is no magic bullet here for folks. It's just really situation specific.
Yeah, absolutely. And you just have to, obviously, if there's not a lot of rate savings by going to the shorter version, then that should factor into the decision too. And I think a lot of the ARM loans today are just not providing a lot of additional savings in terms of interest rate because rates
I
are
mean,
just so darn low.
yeah. So let's talk about rates really quick before we get into this, this rule of thumb here.
Okay.
Years ago, when people were refining and they were going from, let's say, a 30-year fixed at 8% to 6%, I mean, we were doing the happy dance like, oh my God, this is the best rate ever, right? And now rates are, 3% for 30-year fixed or in the low threes, high twos. And, so there's a lot more affordability from and that's what helps drive a lot of the prices. It's all about supply demand and where that rate falls relative to cost and pricing. So just, think about when you're looking at these loans and what type of loan that you're going to be getting and so forth. Like, what's the end plan with this house? Are you going to keep it? Is it going to be a long-term hold? Is it going to be, hey, I'm going to be here 5 years, right? And really just kind of work through that a little bit before you make a decision around a loan that might not be the best decision for you.
Yeah, I can't tell you how many times, Ari, we've had some clients in the office that talk about rates back in the late 70s, early 80s, double-digit mortgage rates. I had an 18% rate on my mortgage when I first bought my house. It's like, and now people complain if their rate's 5,
I know,
because that's too high.
Yeah, like if they got like 4.5, they're pissed, right? I mean, it's like
Right.
it's not happening. Now we're kind of the old guy. I remember my first mortgage was 8% back in 1999. So
Right.
So there we are. We're that guy now. So, anyways,
Totally. So when the next subject on this first-time home buyers, and then we'll move on to refinancing, is really how much debt is manageable. And we get this question quite a bit, even for non-first-time home buyers that are looking to maybe move up. What amount should I be paying towards my mortgage? What amount of my income should be going towards it? And our rule of thumb has been around the 25 to 35% of your income, your gross income, should go towards mortgage. And when I say mortgage, we're talking about principal, interest, taxes, and insurance. So what they call PITI. And so all of that should not be more than about 25 to 35% of your income. We live in a higher valuation area, and so that might come up to maybe that 28% range. We've heard that rule of thumb. And so the example you can see on the screen is, if you're making 150 grand a year, that's $12,500 a month. Well, 30% of that is $3,750 a month going towards that principal, interest, taxes, and insurance on your mortgage. That's about a good, safe number. And then we look at, the 35%, which is the higher end, would be kind of your total debt payment. So if you might have, a little car payment or a student loan payment associated with your debt schedule, that plus your mortgage shouldn't be more than about 35% of your total household income gross. And if you kind of think through that, Ari, I used an example, just a little different example, and I just was penciling it out on my piece of paper here before we started. And I said, okay, let's just say someone's making 10 grand a month gross.
Right.
And let's say that, we use that 30% number. That's 3 grand a month going towards mortgage. And let's say they have some student loans and maybe an auto payment or something. Maybe there's another $500 going towards other debts. That's $3,500. Let's say they're in the 25% tax bracket. So they got to put another $2,500 towards taxes. And then what we as advisors tell clients, or especially younger clients that are first-time home buyers, you should be saving at least 15% of your income towards long-term retirement. So there's another $1,500 a month. All that adds up to $7,500 out of your 10 grand. You only have $2,500 left for food, utilities, gas in your car, entertainment, and other miscellaneous.
Yeah.
So that's kind of where this gets backed into this 25 to 35% range. I can't tell you how many times people come in with trying to buy these huge houses, big mortgages, and it's representing 40+% of their gross income, and that's just too much.
Yeah.
And then you wonder why they got a retirement savings problem.
Right. And it's, the one thing about mortgage qualification is, you'll probably qualify for more than you can afford when you really look at all of your overhead and monthly expenses. And just because you qualify for a certain amount doesn't necessarily mean that that's the safe number or the right number, as far as affordability is concerned. And the other thing as well is Josh, that life isn't linear, right? And sometimes people will stretch that mortgage payment, stretch that affordability just to get in hopes that their income will rise over time. as will their value in their home over time, right? And so, there is some strategy there as well, and it's risky, but it doesn't have to necessarily be one or the other. Like I always say, life isn't linear. Things happen out of sequence sometimes. So
no doubt.
yeah.
So
So
the refinancing piece, Ari, is obviously the part we wanted to spend the most time about, because this is where you're hearing question after question. Should I refinance? Is it the right time to refinance? Does it make sense for me to refinance? And I would say that, even when we're at all-time low interest rates, it doesn't make sense for everybody to refinance. Your
no,
situation needs to be analyzed on each individual basis to determine, does it make sense? And there's things that need to be considered. We use a lot of break-even analysis calculators, and I'll show you an example of one in a moment. But you always need to understand how long you plan to be in that house. How long, have you already paid? How many years are you already into the existing loan? What are the costs? There's going to be costs associated with refinancing, no matter what any lender tells you. It's just a matter of whether you're paying it up front or whether you're paying it in the rate itself, right?
Right. So, the break-even analysis, that's effectively looking at what are you saving over the term of the loan, right? And how long do you have to be in the new loan before you get back to par? That's really what that comes down to, and we're going to get into that. So let's talk about costs, right? Because, it's tax time, doing a lot of tax returns right now. And, I refied my house, I got a no-cost refi. There is no free lunch with loans, right? You're either paying it one way or the other. You're either paying points for the rate, right? Or if you're not paying points, your rate is a little bit higher than par. And what's happening is your mortgage person is getting a rebate, or they're getting paid on the back end of the loan because that rate's a little bit higher than par. So there is no such thing as a no-cost loan. It's costing you something. Keep in mind, it's going to cost you an appraisal. It's probably going to cost you title and escrow and a notary fee, as well as the points or origination fees on the loan. So that's all part of that break-even component. And the other thing as well is, when you're starting that loan over, right, then you're starting that, if you're 8 years into a 30-year loan and you get a new 30-year loan, well, you've just added you've just extended that term out for longer. So you are paying more interest over time. And that's just part of that evaluation on, does it make sense? We had a question in the chat earlier. I've got a 30-year loan that I refied once already. How do I decide if I should refi again? Should I go to a 20 or a 25? You got to look at all those numbers and really, really figure out, okay, where am I at? Where am I going to? And does it make sense for me to save that money over time?
And I think that, the cost piece is, it doesn't mean that costs are bad. It just means you have to understand that there are costs. There's too often where people just think that there is no cost. And I think the key, going back to your point, and I'm going to show it now, is just understanding that, hey, well, because my interest rate, in this example, it's on the screen. Let's say somebody has a 5% interest rate on their current loan, and they go down to a 3.25% interest rate in today's environment. That's an enormous savings in terms of an interest rate over the life of that loan. And so it might cost $3,000 or $4,000 in closing costs, not even talking about points here, but just closing costs in general.
Right.
But you can see in this example, there's dramatic savings. There's almost a $700 a month just payment savings.
Right.
And so in that example, your break even was within 6 months, you've covered all those closing costs, right? And then from that point forward, you're saving. And so the life of the loan now, in this example, says you're saving $85,000 of interest if you held this loan to maturity. And that's even if you're already 5 years in to the existing loan. Now,
Yep.
Not all those break evens look like that. But the point is, this at least gives you a position to start to think about, does this make sense for you or not? If you start to see break evens that are 2 or 3 years long, and then you don't even know if you're going to live in that house for the next couple of years, then that's something that you have to really strongly consider. So there's a lot of ways that you can really look at this thing. And then the other thing we talk to clients about, where even with this example, it makes sense. They say, well, Josh, I'm already 5 years in. I only had 25 years left. Well, in that case, go ahead and refinance to the 30, but keep paying the payments you were making before at the lower interest rate, and you'll pay it off well before 30 years.
Right.
Or pay, take some of that savings and continue to add towards principal so that it actually still pays off in that same amount of time.
Right, right. You can always pay your loans down early. Most loans, I haven't seen a loan with a prepayment penalty in 10 years, So you can always pay your loans down earlier than the normal schedule. By the way, I forgot to mention, if people are having trouble seeing the slides and want to go to full screen mode, in the upper right-hand corner of our presentation, there's a little box that's white. If you click on that, this will go to full screen if you're having trouble seeing the numbers. But yeah, I mean, it's you really can't. It's not all about just my payments lower, right? That's not always the answer. You really got to look at it to see, okay, what am I saving? What is this costing me over time? And does this make sense? And I had a client call the other day. He's like, hey, I'm looking to refinance my house. I think I can get a better rate. I said, great. I said, what's the end plan? Well, I'm going to retire in 2 years and probably move out of state. I'm like, all right, so why are you refinancing? Right? Because there wasn't, by the time he broke even, he'd be selling the house anyways. Right? So just didn't make any sense. Right?
And obviously, your financial advisor should be working through these numbers with you. If you're not working with a financial advisor, the mortgage person that you're working with should certainly be running these numbers to show you, hey, does it make sense? If you're working with any good fiduciary, they're going to tell you, hey, this does or does not make sense based on these calculations, and ask you those types of questions. Well, how long you plan on staying in the house? How long have you been in the current mortgage? Things like that are all going to determine whether or not this makes sense for you. This was an easy example, right? 5 to 3.25, but there's a lot of people that are asking us that might be at 3.5, asking if they should refinance down to 3, or
Right.
3.75 down to 3.25. Those are tougher ones because that's a tighter gap, and those break evens may take a little bit longer to recoup some of those costs. And so that's where you have to really look at it a little bit closer.
Yeah, I had one the other day where they were at 4.5, but they were 12 or 13 years into their loan, and with only a $200,000 loan balance, right? With potentially moving in 3 years. So that's kind of one of those ones where you got to look. Really quick, we had a question about appraisals on the refi and home improvements, and the question specifically was, would you remodel a kitchen before a refi to get a higher appraisal? So the only time where the value of the home is a factor relative to a refinance is if the home mortgage debt is so high that there's a challenge on that 80% loan to value ratio. So it really depends on, what's your existing loan balance? What is the home value? Does the old kitchen or new kitchen have that much of a change in value where that 80-20 ratio doesn't make sense? So hopefully that provides some perspective.
Yeah, a couple other things I'll just mention on refinance that I think are important points to bring up. Cash out refinances. If you're going to take cash out, you're going to most likely have a little higher interest rate for that. The bank's going to charge you a little bit more for a cash out refinance compared to a regular refinance.
Right.
Another thing,
cash out.
Say that again?
I said they call it a rate term refi versus a cash out refi.
Right. And so that's one thing. The other thing that you should keep in mind is if you have and we're going to get to line of credit in a moment, but if you have any type of seconds or lines of credit on your existing house, the bank might ask you to close that in order to do the refinance. That's something that we see happening. Right. And then if you have an investment property that you're trying to refinance, also understand that those rates are going to be higher than your primary residence. So some people are saying, well, I want to refinance my investment property, and then they're surprised when they see that the rates are higher than what's published out there, and it's because it's an investment property. Right. And then the last thing I'll say is the jumbo loans, these really big loans. I think in San Diego now it's 775,000 or above or something like that. That's the jumbo. But even bigger, you get into the million and a half size loans. Those are going to probably have a little bit more of a challenge in terms of the underwriting process to get those through. And there's only a handful of big banks that are pretty competitive in that area. Yeah. And somebody just gave us that answer. It's 753, 250 is the jumbo limit. So anything above that is considered a jumbo loan. So just keep all that in mind if you're in those categories when you're thinking about the refi.
Yeah, and so for those who do have investment properties that they want to refi as well as their primary home, and maybe they have a line of credit, oftentimes it's more beneficial to bring that in all those loans to one lender, and they might be able to put together an overall package that may be better than farming each of those loans out individually, right? So So that's something to kind of take into consideration as well, assuming that it makes sense to look at all of those at the same time. So second loans and home equity lines of credit, right? So, this is not typically purchase money. This is like, hey, I want to have that line of credit there just in case, right? Or I want to make some improvements on my house. I'm thinking I want to use some of the equity in the home to make those improvements and not use my savings, right? And that's kind of where these loans come into play. So home equity lines of credits, you only pay typically a small fee every year to have the privilege of having that line of credit open. It's usually $100 or less in my experience, sometimes nothing, depending on your overall banking relationship. And you only pay interest on those loans on the balance that is on them. So, $100,000 loan, probably a couple $100 a month, if that, in interest that you'll pay. It's interest only. And in my experience, most of those home equity loans are due in 10 years or go fully amortized in 10 years from their start date. That's at least the most common thing that I've seen. So it'll be interest only for the first 10 years, and then year 11, it becomes fully amortized. Or you refinance and get another equity line and start that 10-year stretch over again.
And Ari, when we look at lines of credit or HELOCs as we call them, I'm a very big fan in the sense of, and I talk to clients about this a lot, of looking at this as that emergency cash option, right? As that ability to be able to access money quickly if you need it. If you're a disciplined, person with debt, and I've used lines of credit for 15 years now. I always have a line open, and I use it when it's needed to be used, so that I don't have to sell something at an inopportune time if I needed to get cash quickly. And so the idea is it allows you to keep a lot less in cash in emergency reserve in an environment where cash doesn't pay, right? Might get 0 to 1% on cash in this environment. And so for folks that, say, hey, well, I need to have enough in cash for that emergency. Well, this is another ability to have a little bit of an emergency position where you can, hey, grab 20 grand and then work aggressively to pay that back. And to your point, you only pay the interest on the amount that you've borrowed. So you might have in my example, I think I have a 150 line right now. I pay $95 a year to keep it open. And I'm well willing to pay that to know I've got access to that capital if I need it. And only do I pay interest if I take some money out of it. And it's usually a variable or adjustable rate type of a rate, which is based off of usually the prime rate. And it tends to fluctuate, obviously, as that rate fluctuates. So it's a great opportunity, for your point, to be able to do some home improvements, as well as to have it as an emergency reserve. The straight loan would be something with not as common these days, but what they call maybe a second loan on the house, where that you can probably get a fixed rate on, and you can use specifically maybe to a home improvement type project.
So one thing I want to talk about, and I think we're going to maybe segue into this, is some of the tax benefits. So on those equity lines and seconds and so forth, those, in order to get the interest deduction, the mortgage interest deduction on those, on that interest, it has to be used for either purchase money or towards substantially improving your home. If you're getting an equity line of credit and paying off your car or paying off your credit cards and doing a consolidation of your debts, that interest is, by the code, technically not deductible on your tax return. So it's just something to kind of keep in mind. So let's talk about mortgage interest deduction. So there were quite a few changes around this back in the end of 2017, 2018, around how much interest, how much mortgage debt is deductible and so forth. So if you bought your home before December 15th, 2017, you're allowed to take a mortgage interest deduction on your mortgage balance up to $1 million of debt, right? So after December 15th, 2017, under that Tax Cuts and Job Act that went through, the mortgage debt threshold went from $1 million to $750,000 on how much you can take on that balance, a portion to that interest that's deductible. So this was a pretty sweeping change that went through. It didn't stop anyone from buying homes and taking out debt and so forth. So, job of the tax preparer is to take a look at those mortgage balances when you acquired the home and figure out the apportionment on how much of that interest is deductible when you have those high balance loans over 750,000. One thing to keep in mind is if you bought the home pre December 15, 2017, but you refied it, excuse me, after December 15th, 2017, you still fall under that $1 million threshold. It's only for purchases after that date. So, clear enough?
Very clear. Thanks, Ari. I mean, we get questions on this quite a bit too.
Yeah.
We're going to shift over. We're about 30 minutes into the presentation. We're going to shift over to student debt, which has also been a hot topic lately. And we're going to cover just, how much student loan debt you should take on. If you've got kids that are going to college or in college, it's just something you want to kind of understand. And then talk a little bit about the student loan forgiveness that's been discussed, benefits, pros and cons of consolidating or refinancing, and then Ari will cover deductibility on the tax return for any student loan interest. And so the first piece here is just things to consider before. Go ahead, Ari.
Really quick, Josh. I just want to mention the student loan topic. Honestly, we can do an entire webinar on this topic. There is so much tax law and so many different types of student loans out there. I just want to reiterate, this is a very high level overview. We are not going to get too into the weeds on student loan debt.
Right.
Sorry to interrupt you, Josh. Just wanted to make sure.
No problem. But thanks for reiterating that, because he's exactly right. We're not going to dive too far in, but the big things that I think are important when we look as financial advisors and we see what's out there right now. Obviously, you hear in the media there's a huge student loan debt problem, but even with our own clients and our own interactions with folks, is we're seeing way too much student loan debt commensurate to the amount of income these folks are earning when they get out of school. And I think that is the key here to take into consideration when you're looking at how much debt should I really take on. Our big philosophy is that your level of debt should be very much based on your income potential, and no more than about 1 time your projected annual salary upon graduation. And you might ask, well, where do you come up with that crazy figure? And the reason is it goes back to that same comment earlier about how much mortgage debt you should take on, right? And it's about a percentage of your income that goes towards servicing or paying back that debt when it gets into the repayment phase of that. And so, if, as an example, let's say that you are going to come out of school with a $50,000 salary, you want to kind of keep that, total debt load after 4 years of college around that $50,000 mark. Because then when you get into the repayment of that over a 10-year period of time, if that's the goal, that'll be about 10% of your pay would be going towards paying back that loan, if that makes sense. And so that's where we kind of come up with that rule of thumb. And it's something that we've seen in the industry talked about a lot too, is to try to keep it at that level. Too often we'll see folks, looking for a job, or trying to get out of college with a job that pays 50 or 60,000 and have $150,000 of debt. And it just becomes a real challenge getting that paid back. And so that's our big thing in terms of how much you should have.
Right. There's so many different varieties of student loans out there too. There's federal loans, there's private loans, right? And so, and this has been a hot topic really quick, just to transition to this is on student loan debt forgiveness and all that, right? So, Josh, I know you've been doing a lot of research on this lately. Can you walk us through just what the direct federal loans are, and then share, what the other varieties are that are out there?
Yeah, so the big thing that's happened since the pandemic was this idea of student loan relief. And really what they're doing here is basically saying they're not going to charge interest, or the interest rate will be set at 0%. And it started out last year in the pandemic that was going to be through the end of the year. Well, into the 2021 now, they've extended it to September 30th of 2021, where you basically don't pay any interest on those student loans. So it's kind of on pause, so to speak. And the key here, though, is it's only applicable to federal student loans. And as Ari said, there's a lot of different variations of loans out there when it comes to student loans. Although a lot and most of them are in the federal student loan arena, there's also private loans, and that's not applicable here. And so you got to make sure you know what kind of loans that you have. And so if that's the case and you're in a position where you're really struggling because of the pandemic, great opportunity to kind of not allow that interest to be, causing you a challenge, and you can basically defer till September 30th, 2021. Now, the other part of this, however, is if you do have still good income and this is the program, well, this is a great opportunity to start paying these things back quicker because you're not paying interest right now.
Well, that's
And
what I was
so,
saying. If you're not paying any interest on these things, and let's say you don't have any other debts outstanding, right, that have high interest and so forth. What a great opportunity, right, at zero interest to pay off this debt. That's not, you can really knock down the balances pretty quick, right?
right. I mean, especially if you got big balances, I mean, utilize this opportunity to start to pay down some of that principal right now at 0% interest.
Yeah.
So a lot of folks, certainly I don't want to discount the fact that there are people that are, really hurting because of the pandemic and struggling and need this need this opportunity to have the relief. But for those that are still have jobs and are making good income, utilize this the other way, which is to say, hey, let's knock a hole in this thing. The other thing regarding forgiveness, Ari, that's being talked about a lot right now as part of Biden's campaign on student loans is that potentially they would cancel up to $10,000 of federal student loans. Once again, federal student loans, not private student loans. And that's not law yet, but it's being discussed quite a bit and something that's out there. There has been some communication also that potentially up to even $50,000 that's out there, but I don't think that that's getting as much traction as the $10,000 figure. So that's out there too to keep in mind that that could potentially be there. Um, the one thing that it's also exists that's been out there for a while is the public service loan forgiveness, and that's a program that's already in place, which basically says that if you end up working for a qualified public service job, which would be military, law enforcement, schools, nonprofit, tax exempt hospitals, universities, early childhood education, any of these types of careers, then if you actually do a program where you do 120 payments in a row, then the remaining balance can be forgiven at that point. And that is a program that's existing today. We've got clients that are utilizing it. The one thing that's important here, though, is you still got to do the math. You
Yeah.
got to look at what you're paying in interest over that 120-year period or 110-year period of time, 120 payments, and say, hey, if I have the cash flow today, I might still be better off total payments by just paying it down and not accruing all that interest over that period of time. Because at the end of that 10 years, you may not have much of a balance left anyway. So as good as that sounds, you still got to do the math on it to make sure it still makes sense, assuming you have the ability to pay it back. The last thing I'll cover on this piece that I think is important that just came out in the very brand new stimulus package, the American Rescue Act, is that they will, if there is forgiveness that's done, and there's already been some forgiveness on some fraudulent loans that the government has deemed. But if there's any further forgiveness, they're going to make student loan forgiveness tax free through December 31st, 2025. So that's been some of the fear is if they get a forgiveness, then all of a sudden they get hit with a big tax bill because the loan was forgiven.
That was what I was going to say is, yeah, you got your $20,000 student loan forgiveness, right, or whatever, and then you get a 1099 in the mail for 20 grand that you got to report on,
right?
Your tax, right. So that's nice to hear that's into consideration as well, because it's not always that way, right?
Yes, exactly. There's a handful of other small ones, Ari, that are out there. I wouldn't say small ones, but there's some that are not probably as applicable to folks. There's something that's out there, current law, that's teacher loan forgiveness. If you happen to be working in elementary, secondary, or an educational service agency that's actually serving low-income families, then you can get up to 17,500 forgiven. There's a public service loan forgiveness program, which we just talked about.
Josh,
Then there's,
on
yep.
that PSLF, we had a question. Does this apply to municipality employees, or are these federal employees, or these law enforcement, or do we not know?
Yeah. So the way that I understand it is military, law enforcement, schools, universities, tax exempt hospitals, and early childhood education. So
Okay.
if you fall into one of those categories, definitely applicable. Anything that's maybe on the gray area, we'd have to research a little bit.
Okay. Thank you.
The income driven repayment plans, that's another one where you can qualify for certain income-driven plans, that basically says, hey, the more income you make, the more that you'll be able to pay. The less income you make, less you'll be able to pay. And so they kind of set you up on set time frames for that. There's pros and cons to that. There's some forgiveness for military service, and then some forgiveness for AmeriCorps, or some other programs that are currently part of the federal student loan program.
Right.
So there are some different ways that you can get some forgiveness, and then of course we'll wait and see what happens with this 10,000 that's being proposed.
The one thing to keep in mind is this is all federal loans, right? Not private loans, and it really kind of reaches around this conversation of loan consolidation. We have seen folks that have consolidated their loans from federal to private, and unfortunately, it disqualifies them on a lot of these programs that are out there. So you can consolidate your loans after college, sometimes at lower rates and so forth. Like we said, federal to private is a concern, and this is really a conversation around cash flow and interest rates. Josh, I think you put a table together. I don't know if you kept that in here or not, around kind of looking at loans and different ways that to pay them down. The one thing about consolidating loans into a single loan is you obligate yourself for one payment as opposed to a few different payments sometimes. And that can be a bigger burden on improving cash flow sooner. So it's kind of like goes back to that mortgage refinance conversation on, where are you at now? Where are you going to with a refinance? And does it make sense based on your situation? Wouldn't you agree?
Yeah, you're right, Ari. I mean, this is a tricky one, and we get the question a handful of times, especially folks that do have a lot of them out there, where you have 3 or 4 or 5 different loans with different rates and so forth, and the question becomes, hey, does it make sense to consolidate? There's pros and cons to everything, right? And to your point, yeah, it may be a lot easier to manage when you have one loan, one payment, but potentially though, when you're doing a refinance, you might be extending that term again. And so you got to do the math. It's that break-even analysis, right? I mean, for some folks that are struggling, it could
Yeah.
be a positive from the standpoint of saying, hey, it's giving you more time to pay it back and getting you to a lower payment. But you do have to look at what's the total interest I'm paying over the life of this loan. And then
Right.
is there any costs associated with that consolidation or refinance? And so, those are things. And the last thing you already mentioned was the idea of, if you give it back to the private space from the federal, then you're giving up on some of those deferment and forbearance types options that are existing, as well as any forgiveness options that exist, because now you're in the private space. And so you just need to look at that closely before you just say, okay, this looks like a good deal because I'm paying a lower interest rate. Well,
Yeah.
really, what else are the factors there? And then, Ari, why don't you just cover, before we get into the
Sure.
last segment, any tax benefits associated with the student loan interest?
Right. So student loan interest is a tax deductible item. Up to $2,500 of student loan interest a year is tax deductible on your tax return, but it's really dependent on your income, your adjusted gross income. And if you're single and have a adjusted gross income of over $70,000, then that deduction goes away. Married, $140,000. So those thresholds are relatively low for most folks that are making enough money to make traction on these loan payoffs. So the short story is, make sure you look for those student loan interest tax forms when you get your taxes done, and include them on your tax return to figure out, are you getting some benefit or not? Because it could be a deductible loan or a non-deductible loan depending on where your income falls. So consumer debt is the next topic, and we're not going to spend too much time here. We got about 15 minutes left, and I just wanted to make sure we are able to answer everyone's questions. But consumer debt, this is typically non-deductible debt, right? This is your car loan, your credit card. You got that 0% interest for 18 months down at the furniture store, et cetera, right? And it's always non-deductible unless maybe you're a business owner, and there's this might be some interest deduction as a business owner if it's relative to your business. And this is really a conversation about cash flow, right, Josh?
Yeah, there's no doubt about it. And
yeah. So
and here's you can kind of get a feel for the types here, as you're saying.
Yeah. And so oftentimes we get questions from folks, what do I pay off first? Do I pay off the loan with the highest interest rate, or the highest balance, or the lowest balance, or the biggest payment, right? And so it's really a function of looking at what all the debts are, what the interest rate is, what the minimum obligation is, and determining what strategy is the best. My personal preference is typically to take a look and see what provides the most cash flow. And because really it's for folks that have debt issues, it's really a cash flow topic more than anything. Because, if you can improve your cash flow on a monthly basis, in my opinion, that helps make a lot more traction happen in your overall financial situation.
Before I get into the calculator and what we do to help our clients with this particular topic, I want to kind of, from a higher level, just talk consumer debt in general. There's nothing wrong with credit cards. There's nothing wrong with, like Ari's example, the 18 months, 0% financing at the furniture store or the electronics store. I use all that stuff personally. I use a credit card every single month because I want to get points that I can use for other things. And so all that stuff's fine. The key is responsibly managing it, right? And so,
Yeah.
When we do a new furniture purchase or something, they're going to offer me free money for 18 months. I'm probably going to take it. And I'm just going to make sure that I am very disciplined that right before that 18th month, it's paid off. Because if not, all that deferred interest, they're going to hit you with.
Yeah.
And, we run into this and see people that miss that. And that's a hard one to swallow. You got to be disciplined if you're going to use these offers, these 0% here or there. And the same thing goes with these credit card offers, with the idea of saying, hey, this is 0% credit card for 6 months or 8 months or 12 months. Fine. But once you get to that end of that time frame, get in the habit of you're paying that thing off every single month, because this consumer debt is the stuff that gets people in the most trouble. The interest rates are astronomical, and it's mind-boggling to me how often people keep credit card balances with 15, 18, 20% interest rates, and then want to invest money in different other things, thinking they're going to get equal return. It's just not realistic. And so what we try to do when people do get in trouble with this is look at how are we going to pay this stuff back. And we use this snowball calculator for a lot of our analysis. And the concept here is really about, to Ari's point, cash flow. We determine, okay, how much per month do we have in surplus to be able to pay back these different debts or variety of different debts. And then we prioritize them based on the highest interest rate first. And we try to get those things so we make the minimum payment on every other balance. And then all that extra surplus cash flow goes to the highest interest rate debt at that point. As soon as that thing falls off, all that next extra surplus cash flow goes to the next highest interest rate payment. And we knock that one out until we get to a point. And we put a plan together for clients that says, hey, okay, if you follow this plan, in the next 28 months, you're going to have all this credit card and all this consumer debt paid off. And so
the challenge on this thing is managing it on a regular basis and keeping it at the forefront of your mind. Because like I mentioned at the outset, like, life is not linear. Things happen. But debt payoff doesn't happen by, chance. It is, you need to focus on this, and really, really put effort into it, because this stuff does not go away. I mean, we see this, from time to time where, people just have perpetually lived with a $12,000 credit card balance their entire life. And the thought of how much money they're wasting in interest is like, it's so frustrating. So, this is stuff we can help with. But it is an active process, not a passive one.
Yeah, and one of the things that's common too, Ari, is like, maybe someone's got a car loan that's got only maybe 2 years left on it, and the rate's like 3.9. Right. And they come in, they're like, well, I'm going to pay off this car this year. This is my goal, to pay off this car. And yet they still have a $5,000 credit card balance that's charging 18%. And they said, in their mind, I just want to pay off this car because I only have 2 years left.
Right.
No. Focus on the credit card, not the car that's at 3.9%. That's cheap money.
And if you're on the back end of that car loan, you're not paying a lot of interest anyways, right? It's mostly principal. So.
Right. The last thing we'll cover is just this concept of, we see this a lot too, transferring balances.
Yeah.
Balance transfers on credit cards. And the big thing here is, I'm not saying that balance transfers aren't okay. They certainly can be. There's pros and cons to everything. Once again, you have to read the fine print, because at the end of the day, although you might be at a 0% on this balance transfer for a period of time, they hit you with an upfront fee as some percentage of the balance you're transferring.
Right.
And so then you got to do the math. Is it really saving me a whole heck of a lot of money here? And so that is something we see often. And sometimes people don't read that fine print and don't realize that there were fees associated with those transfers. And so
Yeah,
make sure you're looking at that closely.
No interest balance transfer, 5% is what we're going to charge you when you transfer it over, right? So, like I said, no free lunch.
Right. The thing, and I mentioned a HELOC earlier, a home equity line of credit, and this is something we see. I try to say this carefully because once again, it comes with discipline. But if you have a line of credit that's got an open line, and you've got a handful of credit cards that need to charging you 10, 15, 18%, it's a great opportunity to utilize that to pay those off, only if you've got a disciplined plan then to pay back the HELOC.
Right.
Because there's no doubt the interest rate's going to be lower on that HELOC, but that doesn't, we don't want you, to then rack that thing up or go back to, charging up the credit cards again. So, and then I think the last piece on this, which Ari's already pointed out, is all consumer debt, none of it has tax deductibility. So we talk about this idea of good debt versus bad debt. Well, good debt is debt that can be deducted. Bad debt is all the other debt that can't be. And so we want to avoid the non-deductible bad debt as much as possible, and make sure it's paid off monthly, and utilize that cash flow effectively. And so I think, Ari, that was the conclusion, at least of our prepared comments.
I think that's about it. We did have a question about, a lot of times going back to mortgages really quick. And Josh, maybe you know this off the top of your head. I can't remember. I think it's around 8 years. A lot of times mortgage lenders will say, hey, send us a payment every 2 weeks so it corresponds with your paycheck as opposed to once a month, right? And so basically you're making an extra mortgage payment every year, and so forth. So do you know how many years will you knock off your loan by making that extra payment?
I think it's going to depend on the interest rate.
Right.
And so there's a couple other factors. It's not just a set number, but you can see yourself, you could potentially knock off 6, 7, 8 years.
Right.
If you did that consistently over the life of a 30-year loan. There's no doubt that it can add some value. But it's not just a set, if you do it this way, it's that, number of years off.
Right.
There's other factors that go into it. And then once again, we've got calculators for that. So if that's something that somebody's considering and saying, hey, I'm thinking about doing this, well, let's look at what it, you could probably Google it too, biweekly, mortgage calculator, and you could put your exact terms in there and it'll tell you exactly when you'll have it paid off. But that's a rough rule of thumb.
Yeah. And then the other thought is, if this is if cash flow is a concern, or, you're doing that in lieu of saving money in your 401k plan and so forth, if that mortgage interest, let's say, is 3%, right? That's pretty cheap money for someone who's in the 30% tax bracket or 33% tax bracket. Once you figure out tax deductibility on mortgage interest, maybe it's really only costing them 2%, right? So if you do have extra money that you want to use, and there's no other really huge debts out there, that might be an opportunity to put money in your 401k plan or invest money. 401k contributions lower your taxable income as well, and if that investment is earning more than your effective tax rate, then that's a better investment for you. So it's a function of cash flow and really circumstances, but it's some of those conversations that we can help with when we do some analysis for people.
That's a great point, Ari, and we get that a lot too, right? Hey, should I just pay off my mortgage? You get that question all the time, and it all depends.
Yeah.
I think your interest rate is important. In this low interest rate environment, at least me personally, I look at my current interest rate on my mortgage and say I'm in no hurry to pay that off. I'd rather have my money working elsewhere because I think I can earn more on my money in other places than putting it all back and locking it down and trapping all my equity inside my home. But everybody's situation is different. If you're fixed on just saying, hey, I'm going to sit on cash and I'm so conservative, I'm going to sit on cash. Well, if your cash is earning you 0.5% and your mortgage is costing you 3%, they might as well pay it off, because that's negative. That's not in your interest. That's not in your favor. So I think everybody's case is different. You get into higher interest rate environment, it becomes a trickier, more challenging question because that rate is guaranteed. You're paying that interest no matter what, where investments aren't.
Yep. Yep.
And so you have to factor that in. And then, and I also tell people all the time, there's no right or wrong answer to this question, because sometimes just in your gut, it feels good to have no debt. And if
Right.
that makes you feel good, it makes you sleep well at night, it doesn't matter whether the financial numbers make sense or not, it makes you feel better. And so
Yep.
that's nothing wrong with that.
Totally. I always say, if you're sleeping good at night, or not, if you're not sleeping good at night because you're concerned about your debt or your cash flow or whatever, then probably need to look at that and figure out what can help you get to a comfortable place. And sometimes it's a lack of education, right? And so forth. So second opinion service, this is something we've been offering to our clients for years. And this is really around primarily looking at investment accounts that you may have, IRAs, 401ks, brokerage accounts, and so forth, and just kind of getting an idea of, are these structured appropriately? Is there a way that they can be optimized? And or is everything just in great shape and perfect? So this is a service we've been offering for many, many years, and that we want to remind folks that it's available for you, for your friends, and so forth. It's a very, very simple process. We do a virtual discovery meeting, kind of get to know, high level overview of the situation, get an idea of where all the assets are, and then, circle back and just, share our findings. Hey, this is how your investments are structured. Take a look at the risk profile, and, maybe look at some alternatives so folks have a little perspective around their situation. There's all
one
sorts
thing before you hit this, Ari, I just want to make sure I don't forget this. In terms of upcoming events, we do not have a webinar in April because we're doing our most popular event of the year, which is our shred party, and that's on April 24th. It's a Saturday from 11 to 1. We do it right here in our parking lot, where we have an industrial shred truck come in. In the past, pre-COVID or pre-pandemic, we used to have a little real party and had tacos and beverages and so forth. We're still coming out of this pandemic, so we're going to keep it really cautious and make sure that we're just doing kind of a drive-by program. But we'll all be out there and helping folks get their documents shredded. But come join us on April 24th, Saturday, 11 to 1 for our annual shred party.
That's always a fun time. We see there's so many people that come through. I mean, last year we were so busy. I think everyone, being on lockdown, was going through their house and cleaning things out. We had so many people come by. I will say this year, no hard drives, no electronics, please. Only paper. All right. Okay. So different ways for getting hold of us: email, phone, social media. We're on social media. If you scan these QR codes, you can get to our website, Facebook, Instagram, YouTube, etc. I think that's about it. Is there anything we missed?
I think we covered it, and we're right on the 1 o'clock mark. So thank you, everyone, for attending. We really appreciate it. Hopefully this information was helpful. This will be recorded, and the recording will go out to everybody who attended. So feel free to share it with anybody who you think might be of interest. Once again, thanks so much for your time, and have a good rest of your afternoon.